Hello, in this short video we are going to see how central bank controls the money and why it controls the money in circulation. So first is when it expends the money flow in the market. So when the central bank expends the money, it will trigger economic growth because the more money is available on the market, which means that the companies which are there in the market, they will grow more, they will open new branches, and they will start more production. So basically, if more money is there, then they are going to expand. If they get cheap money, more money, they are going to expand, which shall also mean that there would be more employment. Okay, so that is the expansionary monetary policy. So stimulate growth by supplying additional money in the market. That is expansionary monetary policy. And what are the triggers for this? So if in case there is increased unemployment or economic slowdown is there, and we want to boost the economy, the central bank wants to boost the economy, it wants to decrease the unemployment, it will pump more money into the market. Okay, and how does it pump more money in the market? So it will decrease the interest rate. If the interest rate is less, then the organizations or the firms which are there, the manufacturing units which are there, they are able to borrow cheap money. People are able to get their loans, they are able to lend money cheaply. So which means a lot of money is flowing in the market, and they reduced the central bank reduced the reserve requirement. So this reserve requirement is basically how much reserve the bank has to keep in their liquid cash which the banks have to keep. So if that also reduces, the banks will lend more money in the market, meaning more money flowing into the market, expansion of the money. So this is going to result in increased inflation because more money in the market means prices of the things are going to go high. At the same time, it will also mean that there will be economic growth. Now the second thing, which is exactly the opposite, wherein the central bank is going to contract the economy by reducing the money from the market. So it is basically going to take out money from the market, and that's what is contextually monetary policy. So reduce the rate of monetary expansion in the market, and that would help it to control inflation. So if a lot of money is there in the market, the central bank increases the interest rate, then what will happen is that the availability of money in the market is very low, and thereby if money is less, the inflation will be controlled. So that's the prime reason why this is done, increase inflation. And then how it is done, what are the controls? Increase the discount rate, exactly the opposite of what we see in the expansionary policy, monetary policy, and raise reserve requirements. So these things are going to mean that less money is there in the market, and thereby people have less purchase power. This will lead to decreased inflation. It is because less money, interest rates are very high, organizations cannot borrow more money from the banks because it's very expensive to borrow. The lending rates are very high, so certainly they will not grow. They will not be having much money to grow, meaning they will not be opening new offshoots for growth, new branches. So the manufacturing will remain muted. And it will also mean, if it is muted, that means there would be increased unemployment. So this is done to control the inflation. Okay, hope you liked it. Thank you very much.